The letter shows up on a random Tuesday, not certified mail, not dramatic, just a plain white envelope that looks like every other piece of junk until you open it. And the first line quietly informs you that you owe the government $9,214. Not because you scammed the system, not because you got caught doing something shady, not even because you suddenly got rich, because you did something unbelievably normal. You moved, or your cousin started helping with groceries, or your hours at work changed, or you got married and didn't think it mattered because my spouse doesn't touch my money. And now the Social Security Administration wants their money back like it was a loan you forgot you took out. This is the part nobody explains clearly. With Social Security and SSI, the biggest financial risk usually isn't the rule you break on purpose. It's the rule you break by accident. Because the system is built on one uncomfortable assumption: your life will change, and you will tell them, fast. And if you don't, they don't just adjust you going forward. They can reach back into the past, redo the math, and turn your normal life change into a debt. So today, we're going to make this simple. What changes do you have to report to SSA? Which ones destroy payments the fastest? What's the timeline? And why does the system feel like it's waiting for you to mess up? Let's start with the weird truth hiding underneath all of this. SSA doesn't watch your life. They don't know you got a roommate. They don't know your aunt started paying your phone bill. They don't know your boss moved you from 20 hours a week to 28. They know what's in their file, and that file is basically a monthly calculator. Every month, the calculator spits out a number, your benefit, and it uses inputs like income, living situation, marital status, resources, where you live, whether you're in the country, whether you're incarcerated, whether someone moved in, whether you started or stopped work. The scary part? The calculator keeps paying based on the last version of you that it understands. So if your real life changes but your SSA file doesn't, the system keeps sending money based on old information. That's how overpayments are born, not as some dramatic fraud story, as a lag, a delay between reality and paperwork. And when SSA eventually catches the lag through a redetermination, a data match, a wage report, a mail notice, an office visit, a random review, then the calculator doesn't just shrug, it reruns the old months. It says, if we had known the truth back then, we would have paid you less. And the difference becomes a bill. That's the hidden mechanism, not your benefits got cut. More like, your benefits were temporarily wrong, and now the past is being corrected, so the whole game is preventing that lag. That's the first mental shift. Social Security is the delivery truck. Medicare is the toll booth. So where does the toll money go? Your Part B premium goes into the Medicare Supplementary Medical Insurance Trust Fund, the SMI Trust Fund. That fund pays for Part B benefits. It also helps pay for Medicare's administration, the machinery that processes claims and fights fraud. So you're not paying your personal doctor directly. You're paying into a pool that reimburses doctors and outpatient providers after you get care. You're buying access to a payment system. Now, the uncomfortable math. Most people assume the monthly premium is the cost of Part B. It's not. For most beneficiaries, the standard Part B premium is designed to cover about 25% of the expected cost. The other roughly 75% comes from federal general revenues, taxpayer money authorized by Congress. So your premium is not the whole price, it's your share. That's why it can rise even if you didn't change anything. And if you're on SSI and working, wage reporting has its own deadline rhythm. You're not reporting sometime later when you remember, you're reporting monthly wages quickly, often by the beginning of the next month. This is why people end up with that surreal situation where they think they did everything right and still get an overpayment notice 2 years later, because wages were reported late or reported inconsistently or missing a month, or changed jobs and didn't update the reporting setup. And yes, it can feel absurd. You're disabled, you're trying to work a little, and now you're doing monthly accounting like you're running payroll for a company. Welcome to the machine. Second bucket, home, where you live, who you live with, who pays for what. This is the one that blindsides people because it doesn't feel financial. It feels personal. You move to a new place. You change your mailing address. Someone moves in, someone moves out. You start living with a spouse. You start staying with family. You leave the United States for an extended period. And then there's the sneaky one, help with living expenses. If someone starts paying your rent, or covering your utilities, or consistently buying your groceries, or you move in somewhere and you're not paying your fair share. That can matter, especially for SSI, because SSI is extremely sensitive to support and living arrangements. People hear income and think cash, but the system often cares about value. If your friend is basically subsidizing your life, the calculator may treat that like support that affects the benefit amount. And this is where the irony gets painful. A lot of people move in with family because they're struggling, they're trying to survive, and the system can interpret that survival move as a reason to pay less. Not because it's evil, because the formula is designed that way. Third bucket, family status, marriage, divorce, death, kids, household changes. If you get married, report it. If you get divorced, report it. If a spouse dies, report it. If someone in your household dies, report it. If you become a parent, birth, adoptive step, report it. If a child on benefits changes school attendance status, report it. And here's a classic trap. Someone thinks, we're married but we keep finances separate. SSA doesn't care how romantic your budgeting is. Marriage can change the inputs, period. Especially for needs-based programs like SSI, where a spouse's income and resources can affect eligibility or payment. And even outside SSI, marital status can affect auxiliary benefits, survivor situations, and other benefit calculations. Fourth bucket, paperwork reality. The stuff that doesn't feel like a life event, but absolutely is. Name changes. Citizenship or immigration status changes. Being admitted to or discharged from an institution, hospital, nursing home, correctional facility, being convicted of an offense, having an unsatisfied warrant, getting released from prison, leaving the U.S. long enough that it affects eligibility rules. And if you're receiving disability benefits, there are extra landmines. Your medical condition improves. You return to work, even if you think the amount is too small to matter. Your work expenses or disability-related work supports change. You start receiving workers' compensation or another public disability benefit. None of these feel like income updates. They feel like life, but to SSA, they are inputs. Now, the next thing people misunderstand is the timeline. They think reporting means mention it at some point. No, SSA tends to expect changes reported fast. Often by the 10th day of the month after the change happened, or for SSI, no later than shortly after the month the change occurred. So let's make that concrete. If you got married on January 27th, the safe mental model is report it by February 10th. If your income changes in April, you don't wait until summer. You report in May. And if you're on SSI and working, monthly wages are on a tighter loop, reporting wages early in the next month so the next payment is accurate. This is why the most dangerous phrase in this entire world is, I'll tell them later. Because later turns a simple adjustment into a retroactive correction, and retroactive corrections become debts. Now let's talk about consequences, because this is where the stakes climb. When people hear you must report, they assume it's just bureaucracy. It's not. If you don't report timely and accurately, a few things can happen. 1, you can be underpaid, meaning you don't get money you should have gotten as quickly as you could have. That's the part nobody focuses on, but it's real. 2, you can be overpaid, and SSA can tell you to pay it back. And 3, this is the part that feels like it belongs in a different movie. SSI can apply penalties for failing to report, with dollar amounts that stack, and in serious cases, they can impose sanctions that withhold payments for months. That's not a slap on the wrist. That's rent money disappearing, and it leads to the moment that makes people feel like the system is gaslighting them. But I didn't do anything wrong. In their mind, they didn't. In the calculator's mind, the file was wrong, and the wrongness created a payment it shouldn't have. Now, here's the hype versus reality section, because the internet is full of bad advice. Hype, SSA already knows. Everything is computerized. Reality, SSA gets information in different ways on different timelines, and it's not always fast or clean. Some things match automatically later. Some things require you to tell them. And even when they find out, it might be months after the fact, meaning the debt has time to grow. Hype. If it's a small change, it won't matter. Reality. Small monthly differences become big retroactive bills. A $90 difference for 12 months is $1,080. A $200 difference for 18 months is $3,600. That's not abstract. That's someone's emergency fund. That's someone's car. That's someone's ability to buy groceries without panic. Hype. Only income matters. Reality. Income is just one bucket. Living arrangements, household changes, support with expenses, marriage, leaving the U.S., institutional stays, these can matter too, especially for SSI. So what do you actually do with this? Because I'm not going to sit here and say, just be careful, like that's a strategy. Here's the practical way to think about reporting without turning your life into a full-time paperwork job. Step 1. Assume SSA wants to know about anything that changes your money, your household, or your status. If you're debating whether it counts, treat that debate as your warning light. Report it anyway. Step 2. Use the cleanest reporting channels you have. For many people, that's a My Social Security account for certain updates like address and direct deposit. If you're on SSI and working, that might be the wage reporting app or automated wage reporting options. The goal is simple: reduce friction, reduce lag. Step 3, keep proof like you're dealing with a cable company. Date, time, who you spoke to, what you reported, confirmation numbers if you get them, screenshots if you used an online account, copies if you mailed anything, because here's another uncomfortable truth. If a problem happens later, the system respects documentation more than memory. And step 4, don't confuse reported with processed. Sometimes you report something and it doesn't update immediately. That's exactly why proof matters, and why following up matters if the change is major and your payments look wrong. Now let's zoom out for a second, because this is bigger than a checklist. SSA is trying to do two conflicting things at once: pay millions of people on time every month, and also calculate benefits based on lives that don't sit still. Lives that change weekly. Jobs start, jobs end, people move, people get sick, people recover a bit, people lose someone, people get help from family, people lose help from family. The system is built on self-reporting because it has to be. But self-reporting creates traps because human beings don't think in by the 10th of next month timelines. They think in, I'll handle it when I can breathe. And that gap between the way humans live and the way the calculator works is where overpayments are born. So here's the question I want to leave you with. If your benefits depend on a system that turns your life into inputs, into what happens when life changes faster than the paperwork can keep up, and more importantly, who ends up paying for that lag when the system finally catches up?